All right, so welcome everyone. Today we have a webinar being presented by Rosenthal and Rosenthal. I want to first thank them for their support. They are an Empire community partner in Naturally, New York. So thank you, Cassie. I see you on the call. And without further ado, I'd like to introduce Megan Slovak, who is the Senior Underwriting Manager at Rosenthal Trade Capital, and Senior Portfolio Manager, Jennifer Draftcorn. Without further ado, we're going to jump into the presentation. If you have any questions, feel free to drop them in the chat or DM us directly, and we'll be sure to answer them towards the later end of the call. All right, so without further ado, Jennifer, Megan, please take it away.
Great. Good morning, everyone. Good afternoon, maybe for some. Jennifer and I are so excited to be here today to talk about PO financing and ways to utilize PO financing, how it works, and what a great trade finance tool it can be for your businesses. We hope that you find this session valuable, and please feel free to drop any questions in the chat box as they come up, and we will leave room at the end to try to go through those as once we complete the presentation. As a quick intro, Jennifer and I are with Rosenthal and Rosenthal. We are an 86-year-old family-owned non-bank commercial lender. We are headquartered in New York with offices in also in Atlanta and Los Angeles. We offer a wide variety of different financing tools to clients in the lower to middle market across a wide range of industries as well. We're here today to particularly talk about the PO financing product. My role is the underwriting manager of the PO finance division at Rosenthal. I've been with Rosenthal almost 7 years. I came on to help grow the division, which was started a little over a year before I came on board. My background is in asset-based lending, primarily with consumer products brands. Yes, now at Rosenthal, I assist with all of the underwriting and support the new business efforts for our division. And I will turn it over to Jennifer to introduce herself.
Hello, everyone. So I joined Rosenthal at the inception of the PO Finance division and have been here going over 8 years now. And my background started in the apparel import and wholesale side. So I spent several years there learning what that industry has to offer. And with the companies that I was working for, working with finance partners at the time, my position ended up morphing over into the finance side. So I bring that background into the finance field, and have been in the finance field now over 20 years, 25 years. And my specialty is on working with the clients, customizing the type of, customizing the type of financing that you need. And also on the import side, working with your suppliers and all your third parties that it takes to bring the goods landed here into the United States. Megan?
Yep. So we can dive right into what PO financing, what it is, why clients come to us, and how to utilize this specific financing tool in conjunction with either an existing accounts receivable line, bank line of credit, or any really other alternative form of financing. Some questions to think about when you might want to come to PO financing. Is your business, less than a year or two old and you don't have as much sales history? Did you just land a huge sale with a big box retailer, a Costco, a Walmart, a grocer, really anyone in that space that you might not normally be able to take on with your existing financing? Do you have heavy customer concentrations or an exclusivity agreement with one of your main customers that a bank might not be comfortable with that extra concentration limit? You know, have you raised capital, but you need financing specifically to help with some of your supplier payments, whether it's domestically or internationally? Did you just start a relationship with a new vendor, again, both either domestically or internationally, that you might not get sufficient credit terms with right off the bat, that you might need some assistance with? Those are all the types of questions that you might want to think about when you might want to come to a PO finance lender. PO financing essentially is a short-term transactional inventory financing solution for cash-constrained businesses, or again, businesses that might not necessarily have sufficient credit terms with their existing vendors or new vendors. Clients that would come to, or prospective clients, I should say, that would come to a PO finance lender are distributors, importers, manufacturers, assemblers, exporters, prospective clients that have landing government contracts that face cash flow challenges. Typically, in our case, with PO financing, we can provide PO financing for transaction sizes somewhere from between 250,000 up to 25 million. If you have seasonality, that's a great example or a time to use PO financing. If you have holiday orders or need to bring in inventory for Chinese New Year, or before Chinese New Year, you know, any type of seasonal holiday type businesses where you might have a spike in your need a spike in your inventory to bring in goods. Those are all times when PO financing or bridge financing would be a great solution for your business. PO financing, I mean, there's a few different methods for PO financing and how we fund, and Jennifer's going to jump into that in a bit. And in PO financing, historically, most people know PO financing for apparel and accessories. What we're finding over the years is the industry base has really expanded. We have many clients in the food and beverage space, the health and wellness, cosmetics, industrial products. As I mentioned before, government contracts for specific products that the U.S. Army or U.S. Navy or whoever might need. But essentially, you can think of PO financing in general as a bridge to support supplier vendor payments until such time that you deliver and invoice your product. PO financing typically is a complementary product to either existing, as I said, lines of credit with banks, or existing factoring lines, existing asset-based lines. And it gives you that additional liquidity that you might need, as I said, for the seasonality, or if you're cash constrained, if you landed a large order. And we can kind of go hand in hand with those existing lines. It's not typically a standalone facility. PO finance is not necessarily just a standalone working capital financing solution. It does typically go hand in hand with your existing or newly established lines of credit, factoring facilities, etc. So that's kind of an overview. I'd like to flip it over to Jen to talk a little bit about the different methods of PO financing, how we actually fund suppliers, the difference between traditional inventory financing and the difference between PO financing there.
So most of you, I'm sure, are familiar with the traditional types of inventory lending, but I can walk through and discuss how PO financing can help if the traditional type of lending doesn't really work or give you the solution for the type of sale that you have. In a traditional setting, your bank line or your factoring or asset-based line is a set line. And when you have potential sales volume that may exceed that line, that's the time to look for alternative financing like a PO finance line. We come in when you have definite sales and you know the time, you know the dollar amount. It can be seasonal, it can be incremental. Your traditional lender is normally secured by inventory, but in a PO finance situation, we're secured by the finished goods, raw materials, the assignment of proceeds from your sales order, from your sales customer sales order to you. But it does need to be a defined sales order opportunity. It's not for just bringing in inventory to have on hand. With an inventory line in the traditional setting, typically your advance rates are 40 to 50% of the inventory. With PO financing, we look at advancing up to 100% of the cost of the inventory based on the overall sales of the purchase order that's presented to us. So for a quick example, if you have a purchase order for $1 million and you're on the inventory side, that inventory is only $500,000 for the cost of goods. On the traditional lender, on the inventory side, you're going to get at most $250,000. But on the PO finance side, on that $1 million sales order, we could advance up to 70%, maybe higher, depending upon your circumstances. But at the 70%, we'd be able to cover $700,000 of the cost of goods plus your landed costs. So depending upon what your margins are on the PO finance side, and we could potentially cover 100% of your cost of inventory. With the traditional banking lines, monitoring is more passive and relationship oriented. On the PO financing side, it is a little bit more intensive because we're transactional oriented. So the monitoring will be more transactional based in terms of the production cycle, the in-transit, if there is in-transit cycle, and timing for goods in the warehouse. So we'd be looking at all of that. But as a total package, it works well for many types of circumstances, which Megan explained. In the traditional setting, it differs by inventory or by lender or type of line you have, but the inventory may be on hand for a while. In PO financing, we're typically looking for transactions that turn anywhere from 30 to 90, 120 or 120 days. So we're not looking to finance something that's going to be sitting around in a warehouse for 6 months. It needs to be a quicker turn than that. But again, each program differs. So we work to construct the type of financing that you need. Adrian, if you could move forward to slide 8. Thank you.
One thing, Jen, I'll just chime in too, and you brought up a good point with the margins and kind of how you analyzed the finished goods inventory line versus the PO financing is typically with the PO financing, as Jennifer said, using kind of the $1 million order example, and us being able to fund 70%, potentially up to 75% of the sales price. Ideal PO finance candidates would have margins of somewhere in that, call it 25% range. If it's less, it's not necessarily a problem, but just because of the nature of what we do, you probably, if you don't have 20-25% margins, there's going to be a big differential of a cash shortfall that the client might need to come up with in order to fulfill the full cost of goods to your suppliers or manufacturers. So Jen, just wanted to, sorry to chime in, just add that piece. So think of PO financing for businesses that are margins of 20-25% or higher.
Thank you, Megan. That's great information. So how does PO financing work? Again, PO financing can fund up to 100% of the cost of goods, related freight cost, duties cost, warehousing cost. And again, it's against the sales of the assigned sales customers' purchase orders. So it's not a line of credit where the funds come directly to you. We fund your suppliers directly, which is why we need to understand the bills of material and the payment terms for each supplier. We also need to understand your landed costs, because all of that goes into your overall margin and what potentially we can cover for you. We don't provide cash deposits to your vendors. That's an unsecured form of lending, and it has its own risk. But what we do is we can work with your suppliers, and sometimes it's one-on-one working with them. Sometimes it's working through you to come up with payment terms that work for your suppliers. And in an international setting where you're importing, typically the number one type of payment that is used is a documentary letter of credit. But we can also do wire transfer payments, purchase guarantees for domestic suppliers, and also in the bank setting, if you want to work with the bank, but you don't want to make a payment or have that letter of credit sitting out there, there's also bank documentary collection, which is it's paid after the goods are on the water and your supplier presents those documents to the bank, and then the payment goes out through the banking channel that way. But let's talk a minute about documentary letters of credit. In a lot of situations, a documentary letter of credit will cover that transaction. So specifically what we're purchasing, the timing that you need it, the production schedule, and where you need it shipped to. All of that is in your documentary letter of credit. We sometimes get asked about standby letters of credit. And for PO finance, which is transactional financing, a standby letter of credit doesn't work because it doesn't provide the specifics of each transaction. And it's based more on a period of time for a 6-month or a 12-month standby letter of credit, which is not what PO financing is. So with a letter of credit, the supplier overseas is guaranteed payment if they produce and ship and present compliant documents. So a lot of times that's very advantageous for the supplier because they have the comfort of knowing that they are guaranteed payment. The other method that has also become popular is international wire transfers, which is used for PO financing payments as well. In this instance, typically a payment does not get made to the supplier until title has transferred on the shipment. And I know that's a technicality, and I'm not going to go into the details here, but before payments made, what we're typically looking for is that ownership has transferred to our client. So let's see, sorry. I wanted to mention one other type of financing that we do, not just the import side, and that's the production financing side. So if you manufacture productions in your own facility, or if you use co-manufacture, co-packers, we can work with that as well. It's purchase order financing, but we refer to it as production financing. So with this, you may require funding of raw materials or purchasing of components, your labor, your overhead. We can pull all of that together and we look at your bills of material, your production timing, your cash flow, to put together a package that would work for that type of financing as well.
Thanks, Jen.
Yeah.
I will, that was really, Jen laid out all the different ways in which PO financing can be funded. Now, some of you might be wondering, what is exactly is the cycle? I would say, once we have a PO finance client, what happens is they will present, our clients will present to us for a transaction, their purchase order, their customer sales purchase order. That's essentially what we utilize as our collateral to determine the availability of the funds that we can outlay for the transaction. So using kind of an example of $1 million order from Costco, we'll use $1 million order from Costco, we're lending 70%. If we're comfortable with the order and the timing of the order, we would then, as Jen said, need to understand how many vendors need to get paid. Is it one vendor as an import? Is it multiple vendors with a co-manufacturer? Once we determine that, and what the exact costs are included, if there's any related freight and duties on that order, that's how we kind of structure the transaction there. And our transactions, as Jennifer said, run from, and once we determine if we're funding via a documentary letter of credit, a documentary collection, international wire transfer, or a domestic purchase guarantee, that from the point in which we issue that letter of credit or make that wire transfer, that's what we consider the start of the transaction. And that kind of ties back into what Jennifer was saying, that we like our transactions to be somewhere in that 30, 60, 90, maybe 120 days. It's short-term transactional financing. And so we hold, once that purchase guarantee or letter of credit is issued, we then hold that loan exposure until such time that the goods either come in the United States or are manufactured in the US and there's an actual product. And once that product, whether it's a shirt or a pair of sunglasses or whatever it may be, is delivered under that purchase order to Costco, that is the point in which that we would look to the accounts receivable lender, which I'll get to next, or the asset-based lender or your line of credit, to advance on that now receivable, that invoice, to pay off and retire the PO finance loan and carry the receivable, the collection period, whether you're offering Costco net 30, net 60, net 90-day terms. We rely on an outside or internal factoring facility, receivable finance facility to pay off. We, as PO finance lenders, do not typically hold the receivable through to collection. And Adrian, we can kind of jump to the next slide for this. So typically PO finance lenders, again, as I mentioned earlier in the presentation, go hand in hand with an accounts receivable facility, a factor, a bank line with receivable lending, or an asset-based line. And that is because, again, we are that transactional, that bridge period, and we rely on the receivable lender to hold the receivable, the collection period. And again, it's for everyone's benefit, essentially. PO financing is slightly more expensive financing than your traditional factoring or asset-based line. So you don't necessarily want to be paying PO finance charges for the length of the transaction and the net 30, net 60, net 90-day collection period from your customer. So that's why we work with factors, asset-based lenders, to kind of provide the full solution for your transaction. But that's kind of high level how it works. And that's why we work well with other banks, other lenders, other factors. And it is a great complementary product to, if you already have an existing line, or if you're looking for a line, we either work all in-house with Rosenthal or with other lenders, other banks, to provide the solution for you to get you this extra liquidity on the PO finance side. So I think at this point, that's how it works. Jennifer and I were going to run through a couple of examples of a PO financing transaction. If we want to jump to slide 15. These are some just examples. I'll let Jen run through the first one and I can run through the second one. These are kind of different examples of a PO financing client or solution that we can offer.
So this first case study that's up is based on a domestic supply chain, and it's a light production financing. So the company was initially doing 8 million in sales. They came to us with a sales opportunity for 2.5 million with a major beverage distributor. It was a new product. They had an AR concentration and an exclusivity agreement selling only to one customer. So very difficult sometimes for your traditional factoring or asset-based lender to get behind that, coupled with the fact that it was a brand new product to the industry. So they came to Rosenthal looking for purchasing and production overhead, and we were able to provide for them purchase guarantees that were acceptable to their domestic suppliers. They had a co-manufacturing facility, so we were able to get comfortable with that and provide the funding throughout that production cycle, allowing the clients to complete the finished goods timely. We did this a couple of times with the client, and after a few cycles of these volume shipments, they were able to improve their financial position, and we helped fuel that growth. Unfortunately, they moved away from using us, but we call that a success story. So it was a very good transaction for us done in the food and beverage space.
And that's a great point, Jen, too, is with a success story like that. I will say one thing that jumps out is not all of our clients are with us for years and years and years. We do have very consistent clients, but PO financing is a great trade tool for just, if you need us for that incremental growth or, or the bridge just to kind of get you through the first, big order you might get. We don't expect that all PO finance clients are with us for life. We actually like, we appreciate when clients can, what we call, graduate from PO financing, if they can start to manage their cash flow on their own and just get the more traditional receivable financing or asset-based lines. So you don't have to think of PO financing as a long-term solution. It could be a great short-term solution, or if it's working for your business, we have plenty of clients too that are with us for the long term, just based on what their needs are, or needing us for the letters of credit or the purchase guarantees. So it really just depends on what your financing needs are at the time, or for the long term or short term. So I'll jump into the second case study, the second example. This was a client who already had an existing factoring line, but landed a large order. Again, this falls into more of the seasonal holiday category. They landed a large order with a retailer that they needed the additional liquidity. So they came to us to add on a PO financing line with their existing receivable financing line. And they needed us because their supplier was overseas and was looking for a letter of credit as a guarantee of payment once the product was completed and shipped. So we were able to provide 100% of the cost, including the freight and duty, based on their margins, for this particular client to bring in this extra inventory that they needed to fulfill this large order that kind of exceeded above and beyond their normal cash flow capabilities. And they were able to complete the sale and continue on with their normal course business, with us financing that that additional large sale. So that was another success story as well. And these are kind of just two different examples of how PO financing work, one more on the international import side. And as Jennifer went through, that would be more of a domestic co-manufacturer, which, you know, we see a lot more of in the food and beverage space, in the health and wellness, or cosmetic space, where you're working with a co-packer or co-manufacturer and procuring, you know, components or ingredients or raw materials that ultimately get completed into the finished product. So two kind of different examples there, but both fall into the realm of PO financing.
And one additional, sorry, Meg.
Go ahead.
One additional point on the case study that Megan just went through was, prior to bringing in PO finance, the supplier that this client was working with overseas required upfront deposits, 30% deposit. But with us being able to structure and offer them a guarantee of payment through the letter of credit, the client didn't have to put down that 30% prepaid deposit. And so we were able to fund that piece on the backside, because the supplier got comfortable that if they produced the product and shipped the goods per the terms of the letter of credit, they would get paid the full amount of the letter of credit. Thanks, Meg.
Yep. So you know, as I think that kind of almost concludes our presentation, and we'd love to open it up for some questions. Again, Rosenthal as a whole offers a wide range of financing solutions. So depending on what your company's needs are, you know, we can discuss that, you know, at a separate time, but we're happy here to answer any questions about the PO financing product, particularly anything that we might have said today that might have triggered any questions. But hopefully this was helpful for you and your businesses. So I'm just looking in the chat.
Sorry, I lost my I lost my screen there. Okay, we do have a question. So the first question that we have here from Andrea Guzman is, what about in regards to financing a first round of production?
Is this in relation, I assume, I'm gonna just guess that this is in relation to a first time sale of production, or Jen, are you reading that the same way, thinking
I am. It's a new product that's being brought to the market.
So I will say, you know, in our case with PO financing, we typically like to see a little bit of sales history. I'm not saying we need to see years and years of sales history, but we would like to know, as it's part of our underwriting process, that our prospective client can execute based on, you know, what they, you know, based on the order and whatnot. So typically I would say we need to have some sales history there. Again, it doesn't have to be millions and millions of dollars. It doesn't have to be years and years, but we typically, if you got an order for a brand new product, we would want to see you complete some sales cycles there before we were to get involved. I hope that answers the question. And Jen, let me know if you have anything to add there.
Well, we would also then do diligence on the suppliers involved at bringing this product to the finished product stage. Because if you're new to the industry and or bringing a new product to the industry, part of what we look at in our diligence cycle is making sure that the supplier's on board, because you wouldn't want a scenario where you're working with a supplier, but all of a sudden you come to find out that they're not able to produce the amount of production you need in a timely manner. And you don't want your first presentation of these goods to arrive in retail short or not at all, because your supplier fell down on the job. So that's some expertise that we bring to the PO financing side as well is doing diligence on the supplier.
Yep.
Thank you. We have a question from Sylvester Ford. Sylvester, would you like to unmute and ask your question? No. Okay. I think we lost Sylvester for a second. I'm going to jump over to Christine's question in the chat. Can you explain the eligibility requirements further? My company spent the last year creating a new product, so we received very little sales last year, but have sold product for 7 years beforehand. However, we plan to receive a large PO for our new product in the spring.
I think that definitely warrants a conversation, and we'd love to chat more with you about your product, who you're selling to. You know, little sales. I mean, I would say in general, we would look for, we typically in our group would sign a client for, give them a year-long facility, and that facility is open for a year. We could do longer if you want longer, but typically it's about a year. And it's there and it's open for when you want to use us, when you get those large orders. You do not have to run every order you get through PO financing. And that wouldn't be what we would recommend either. It would be to kind of pick and choose those larger orders that make sense to run through the PO financing product. So I would say in terms of our eligibility requirements, you know, I would say ballpark, we'd like to see you doing like $1 million in sales volume, maybe a little bit more over the course of the year. So it doesn't have to be all in one shot. It can be staggered throughout the year, but that would probably be our minimums. But that being said, if it is falls below that threshold, you know, it's still worth a conversation to see what we can do there.
Agreed. And we also look to the expertise of the client. And I saw that you said you have sales historically, but with different products. We would look into those sales as well, into the sales customers that you've been selling that product to. And we would discuss with you, you know, what the product is, why you're bringing it to market, and so on.
And I see a question in here, which actually brings up a very good point about specifically what we see in the food and beverage industry and some challenges, pitfalls, things to keep in mind. One thing that comes to mind with the food and beverage industry, a lot of it obviously is more with the co-packers domestically, co-manufacturers, sourcing raw materials, which again is not a problem for us. Just we have to look at it a little bit differently. For those types of businesses, we do focus a little bit more on your cash flow, your 13-week cash flow. Again, PO financing is a great tool for incremental sales. We're not a full-fledged working capital solution. We're not just going to look at your purchase orders and send an advance to your company. We actually have to understand what the bills of material are, what the payment terms are with your vendors. One thing I would say in the food and beverage space is a lot of, which we didn't get into a whole lot here, but a lot of the, whether it's big box retailers or grocers, they rely on forecasts or buyer commitments, buyer plans, projections for what they anticipate buying throughout, you know, maybe a 6-month period, maybe a year-long period. And that is fine. We actually consider forecasts and buyer commitments as part of a customer sales purchase order, as long as we are comfortable with the support that we get from your buyers. We do completely understand that the Costcos of the world, the Walmarts, and a lot of grocers do not just provide a hard physical PO right up front. They typically will start with a buyer plan, a buyer forecast, or a commitment. So we would ask that you send us that commitment, send us the details from the buyer, whether that's just sharing emails with us, and other type of backup in that way. The one thing I would say, and Jennifer spoke a little bit more to this, and it kind of goes back to the timeline. With those types of forecasts, we typically, PO finance is best used for the actual, what we call the load-in order, or the initial bulk order that those types of companies, and again, I'm speaking because this falls more into the food and beverage space particularly. So those load in orders, the initial, Costco or Walmart will come to you and say, we want 100,000 units now, and then we'll take the rest on a replenishment basis. Replenishment gets a little tricky with PO finance, just because of the long duration it could potentially be out for. The load in order, we can get behind with the buyer commitments or the forecast and say, okay, we know that this retailer is going to take the 100,000 units up front, but depending on sell-through, then we're relying on the customer sell-through. And if it's a relatively new product, it's hard to wrap our heads around, okay, is this product going to sell in the next 3 months, or is this going to sell in the next 6 to 12 months? So PO financing, I would say that's one of the things that we do come across quite often with the food and beverage space, just because of the nature of the sell-through and what the retailers provide for commitments or forecasts. And Jen, let me know if you want to add anything to that based on what you're seeing on the portfolio side with the food and beverage clients.
That's great information, Meg. And again, it's not something that would prohibit us from working with you, because potentially with strong margins, we could see ourselves getting taken out of the AR on the first round of delivery. Sometimes that happens, sometimes it doesn't. And as Megan spoke, when it's the longer time frame, it's very difficult. But if we can support your full purchase need for the replenishment program underneath the PO finance, got the parameters that we have, then you could look to bring in all that inventory. But with the first sale, we would look to get taken out of that transaction if possible. So that's just something to keep in mind, that if you are working on that load in, fill, and then replenishment cycle, we can definitely discuss a situation like that with you.
Great. I see Sylvester's hand raised again. Sylvester, you have a question?
Yes. Can you hear me this time?
Yes.
Okay. My question is, I've got a client that is looking for, they've got a major contract opportunity that is with a major retailer here in the country. They've got to supply a lot of the safety paraphernalia that particular organization needs. They've got to order the equipment. Now, I don't know whether it's got to be manufactured or whether or not where they're ordering from, is it already put together, or safety vests and things of that nature. Is that if it's already put together and they've got to just get it from the manufacturer without a whole lot of labor, additional labor costs as far as manufacturing, is that something that you could purchase the safety equipment that she has to get to the big box organization and then be able to factor later? Or does it have to be manufactured for you to be one to work with?
No, so actually, I mean, that falls into, we would look at that if it's already completed and they don't really need that, what we would consider the pre-production financing. We would look at that as just a traditional finished good purchase order opportunities. So we can certainly bridge that client the period in time from when the good is completed, and if it's domestic, if it's trucked, we would look for a truck bill of lading and carry the exposure until it's delivered to the end customer. So even if that's 2-3 weeks or 30 days, that's no problem. I mean, we would look at that. We consider the production financing in cases where if there is still manufacturing involved and component vendors or ingredient vendors need payments before the product is actually a finished good. So that's kind of the difference there. There's kind of finished goods PO financing, and then there's production or light assembly financing. But again, it's all under the same realm, just looked structured a bit different, but I would, based on what you're saying, it sounds like it would fall into that first category of just a finished good bridge financing, essentially.
And you would work with their consultant in order to work with it, correct?
I'm sorry, we would work with the consultant. Yeah, we can talk to the consultant. Sure, we'd be happy
Yeah,
to.
I'm the consultant. That's what it's.
Oh, sorry, it was hard to hear. But yeah, we'd love to talk to you more about the opportunity.
I'll reach out to you. I am in Atlanta, and you're in Atlanta, Megan, correct? You and Jennifer.
I'm actually I'm on the East Coast. I'm in Florida, and Jennifer's in Denver. But
Okay,
we're all over.
Okay. Okay. I thought y'all were Atlanta based.
And thank you, Sylvester. Your question actually brought up another thought for me too. I mentioned co-packers, and with PO financing, we can structure deals if you have finished product component coming from overseas into a co-packer to have light value added kit making, specific labeling that has to be done, or packaging that has to be done. We can structure deals that work that way as well.
Okay.
Embroidery, some apparel companies that need like certain embroidery, they're sent to a processor. That's also kind of what we would consider as added value too, but those are all fall into the same realm of this type of PO financing. So good point, Jen.
Thank you very much. I'm grateful for this overview that you guys are doing today.
Of course.
Love hearing that. Would anyone else like to ask a question? You're welcome to raise your hand, unmute yourself, drop it in the chat. We have about 10 more minutes left, so don't be shy. Going once, going twice. Anyone else? Okay. Well, if we have no further questions, I guess we could wrap up the call, but Megan, Jennifer, would you like to provide any closing remarks?
I would just like to say thank you so much, Adrienne, for having us today. It was a pleasure kind of speaking for Naturally New York, and we would be happy to set up some time if anyone has specific, like we said, specific financing needs or wants to run any questions by us. We'd be thrilled to talk to you more. So thank you again. It was a pleasure.
Thank you, everyone. I know we threw a lot of fresh information at you, most likely. So once you get a chance to work through it, the slides are going to go out. So you'll have some of that as a reference and resource. If you have particular questions, as Megan said, we're happy to have conversations with you.
Yes, everything will be shared following the call. Thank you all for joining us today. Have a lovely day and happy Valentine's Day.
Happy Valentine's Day, everyone. Thank you so much.
Happy Valentine's Day.